Drawdown can be a great option as it gives you loads of flexibility and you can take as much income from your pension as you like. However, there are no guarantees with drawdown, and this freedom can come at a cost. And if you take too much income from your pension, investment returns are poor, or you live longer than expected, one or all of these possibilities could cause you to blow through your pension quite quickly. One question we get asked a lot is, how much income should I take from my drawdown pension? This is hard to answer as we find people tend to retire at different ages, they have different attitudes to investment risk, and they have different objectives when it comes to either wanting to pass on some of their pension at the end of their days to their loved ones, perhaps, or simply spend it all and leave no inheritance for their children, or if they don't have a family. Dave Ramsey recently caused a bit of a storm by declaring 8% as a safe withdrawal rate. Whilst you will commonly see 3 to 5% banded around, 4% is also very popular as a rule of thumb. We're going to explore withdrawal rates in a bit more detail and the problems with them. We'll touch on other factors that are important before looking at a quick case study that can help you when it comes to thinking about withdrawal rates and how much income to take from your drawdown pension. Starting with the much vaunted 4% rule, this originated from a US study by a chap called Bill Bengen. He found that from the period of 1930 to 1970, a US retiree could have withdrawn 4% of their starting portfolio a year that increased with inflation in subsequent years without running out of money in retirement over retirements of 30 years or less. It assumed an investor was invested in a balanced portfolio made up of US stocks and bonds. The first problem is that Bengen's data was focused on the returns of US stocks and US bonds only. The issue with this is that US stocks have significantly outperformed global stocks, as you can see in the data from a study from Credit Suisse, now UBS, last year, which looks at the returns of various asset classes since as far back as the 1900s. This can have implications if you invest in a more diversified or global manner. This then begs the question, if the US has been the best stock market over this period, why not invest all of your equity allocation into US stocks? Well, one problem with this is the lack of diversification. There's no guarantee that US stocks will continue out to perform their global peers. For much of the 1980s, Japanese equities were the darling of equity investors. However, had you been invested in an index of Japanese equities since 1989, you would still be underwater today, which has to be seen to be believed and is quite shocking. It's impossible to predict your life expectancy and how long you're going to ultimately be retired for. It's reasonable to assume that somebody who retires at age 55 would have to save much more than somebody who retired at age 65. On the other side of the coin, someone who lives until 100 is likely to need much more than somebody who passes away at age 85, all else being equal, and that's even before getting into long-term care and potential care fees. Use an example with the assumptions on the screen now. We're going to take a look at how much income you may be able to take from a £200,000 pension at age 65 and how the length of your retirement can influence and impact your safe withdrawal rate. In these examples, we're going to calculate what amount of income you can take from the outset that will increase by inflation and extinguish the pension at two different ages, 90 and 100. Using the example of someone who retires at age 65 and lives until age 90, this represents a retirement term of 25 years. In this example, you could take a starting income of £9,228 per year, which represents a withdrawal rate of 4.61%. If, on the other hand, you planned for a life expectancy of 100, which is a retirement term of 35 years, you could take a starting income of £6,768, which is a withdrawal rate of 3.38%. Even if these retirement dates don't apply to you, the point remains, the longer you are retired, it may be prudent to plan for a lower withdrawal rate. Before we look at some other issues of sustainable withdrawal rates, don't forget to like and subscribe to the channel, as it really helps us reach more people. Another issue with withdrawal rates is that it doesn't take into account your individual asset allocation or factor in future investment returns. I had always thought that the higher your equity allocation, this would help the sustainability of your retirement fund and mean you could potentially take a higher withdrawal rate as a result, as after all, equities have tended to reward investors over the longer term. This is known as the equity risk premium. However, Morningstar's excellent recent research into safe withdrawal rates, which is well worth a read, and I've left a link in the description, found that if your retirement extends beyond 30 years, lower equity allocation in the past would mean that you can take a high withdrawal rate from your pension, and the chances of running out of money would be less, as you can see on the screen now. I guess this is because the longer your retirement, the greater your chance of being caught in the middle of a real awful period of investing, such as the Great Depression or the bursting of the tech bubble at the beginning of the millennium. Who knows? I tend to be an optimist, but it's possible investment returns could be much worse in the future with the effects of an aging population across much of the West and China, Japan. Climate change is going to present problems, and there's eye-watering debt levels across many sovereign states. Withdrawal rates also don't take into account something called the sequence of return risk. This is the idea that the timing and the order of your returns matter. To put this into context, if the stock market crashed on the eve of your retirement just before you started to take an income from your pension, this will have a significant impact compared to someone, perhaps like me, who's still working and in accumulation, who could just wait until their funds recovered. The best example of this can be seen in the Great Depression type of period or event, such as 1928 through to 1931. Looking at the data for US stocks, which I admit going back that far is a bit patchy, stocks got hammered. If you were simultaneously taking an income from your pension alongside a spectacular market crash, this would be a double whammy. Another problem with withdrawal rates is that they don't take into account the timing of any other income that you may have. Many retirees who wish to perhaps retire early or before their state pension comes into force may wish to take more income from their private pensions before their state pension kicks in, and then reduce the income from their private pensions at that point to help the sustainability of the pension fund. Equally, if you have a defined benefit pension and you wish to retire before the normal retirement age, you may want to delay taking your DB pension so as not to incur any early retirement penalties, which, depending on the type of pension scheme, could be as high as 3 to 5% for each year the DB pension's taken early. In such situations, blindly following an arbitrary withdrawal rate is counterintuitive, and one way to try and mitigate this, which we do, is carry out a cash flow plan every year to see if you're on track and assess the risk of running out of money each year. Hopefully you enjoyed the video. Let me know in the comments how much income you're planning on taking from your pension fund. And if you haven't watched this video, please do so, which looks at a case study of retiring at age 60.